Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. My two co-hosts, Mark Hahn and Nan Fun, are off today. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. And that certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is miscellaneous trivia. Now, we do have a special guest, Brian C. Adams of Excelsior Capital, to discuss the current state of commercial real estate and some other stuff. Hey, Brian, welcome to The Best of Investing.
Thank you so much for having me. Excited to be here.
You're great. So first, give us a little introduction on Excelsior Capital. What's the primary business there?
Yeah, we are a real estate investment firm.
You know what? By the way, we're getting a little bit of feedback, just so you know. Not sure if you realize that.
I don't hear it.
Okay. It sounds a little echoey, but that's okay. Go ahead.
Let me try this.
Okay. And wait, go ahead. Say it again.
Is that better?
No, we're still getting some feedback, but that's okay. Maybe it's just on my end. Go ahead.
Okay. Yeah. So we are a real estate investment firm based out of Nashville, Tennessee, and we provide the opportunity for individuals and families to invest directly into commercial real estate across the Southeast, with a focus on Texas, Tennessee, and Florida.
Oh, okay. Very good. And, it's funny because you and I were kind of kidding around before we came on about I was going to ask you your best piece of advice, and which was the answer comes back, don't go to law school. And I said, well, wait a minute now, if you come back with that answer, that means you probably did go to law school.
Right? Yeah, you'd be accurate. I'm a recovering attorney.
And, recovering attorney. I love that.
Yeah. I think they say in law school is the first year they work you to death, second year they scare you to death, and then third year they bore you to death. And I think that was pretty accurate for me. But it afforded me a good opportunity to learn, but it just was not for me long term. So.
Gotcha. Yeah, it's funny because I got my bachelor's degree in accounting and master's in tax. And when I first came out, a lot of my friends went to go work for back then, which was the big 8 firms. And, putting in 80 hours a week during tax season was not uncommon at all. And I realized, I said, yeah, this isn't quite for me. I mean, it gave me a really good background, but after that, don't want to go further. So getting back to some commercial real estate, why don't you give us the current state of what's going on? It's got to be somewhat in flux, I would think.
Yeah, so it is an interesting time, right? The Fed raising rates is problematic across the board for real estate. Let's just kind of be honest about that. Raising rates mean borrowing costs are higher, which mean investor returns are lower. So that is part of the situation. The other side is, with inflation ripping, real estate has historically been the best hedge against inflationary environments. So we're able to pass through some of those inflationary pressures to our tenants and to our users, and hopefully shield investors from some of those effects. But honestly, if we end up going to a full-blown recession, it's going to be a very challenging investment environment across the board. I personally think real estate will be one of the best bad places to be in that scenario. But it is challenging. It's interesting because the dynamic we're seeing is there are a lot of 65-year-old men who own real estate. They've been through 08, they've been through COVID. They see the writing on the wall and they want to transact, right? They want to take their chips off the table. And so there's a lot of deal flow and opportunity, but executing on those deals, given the current lending environment with rates and a lot of lenders going on the sidelines and being risk off, is very challenging.
Yeah, because a lot of times with regard to the rise in interest rates, where it costs the landlord more, I guess it's partly going to depend on how much he's leveraged, right? Because if he has very little leverage on it, then it's not going to be as affected, especially if he got a fixed rate or long term.
Right, and that's where exactly. So understanding the capital stack behind each investment is really important, right? So the amount of leverage that is on the building, whether or not it's fixed, interest only, floating, variable rate, how long that term is, all those things really come into account. And that's where doing long-term fixed debt right now doesn't make a whole lot of sense if we think rates are going to fall at some point in the next 12 to 24 months. So we've been pivoting towards more value-add opportunities where we can increase NOI, do some things to the property, and then refinance at that higher NOI. And that, even if rates are higher, it still will be a good opportunity. But just doing kind of an arbitrage between debt and cap rate today, those deals don't make any sense anymore.
Interesting. I would think also the banks would be maybe pulling back a little bit with their LTVs, especially with their debt service coverage ratios. With interest rates going up, that's really going to make the LTVs that they're willing to lend at, from 70 down to what, 60, 55%?
Yeah, I mean, there's been a 200 basis point swing in borrowing costs over the last 6 months, and what you're going to start seeing and hearing is broken deals that no longer pencil, repricing, retrading from buyers and sellers.
Yeah.
So in that environment, there's opportunity, but again, getting the equity on board and getting the debt on board and executing, given all the volatility, is the biggest challenge right now in real estate.
Well, especially with a recession looming, if not already in, is really going to make it challenging, to get the right tenants in, because you don't want to have that turnover. Tell you what, Brian, stay with us. We're going to go to our first commercial trivia question here. First trivia question. And again, as a reminder, if you know the answer, don't say anything until we get back. Okay. Before being renamed, what was Mumbai called? Mumbai. Remember the place in the Far East. All right. What was its previous name? All right. Call 888-912-1190. First caller with the correct answer wins that tanning certificate, which is worth over $100. Stay with us. The Best of Investing will be right back. Welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with our special guest, Brian C. Adams, president and founder of Excelsior Capital. So we were starting to talk about the commercial real estate market and the various metrics that were driving it. Are there different demographics though? Like you're primarily in the Tennessee and Texas market, right?
Yeah, that's right. Texas, Tennessee, and Florida are the primary markets for us. And that's just pretty straightforward investment thesis where you've got this huge demographic push of people relocating to the Sun Belt for better business, better taxes, better weather. And demographics are destiny in real estate. And so we've been investing in these markets for a long time. They've experienced huge population growth, wage growth, job growth, et cetera. And it's a rising tide mentality when it comes to all facets of real estate. There was, I think, a long time, a concept on Wall Street and the media where this millennial generation, which is the largest working generational cohort in American history, roughly 75 million people, were always to live in major metros and eat avocado toast and live in an apartment building in New York or San Francisco. The reality is that's just not the case, right? The Great Recession pushed back that family formation phase. But even pre-COVID, they were looking to move to different metros based on access to single-family homes, access to education for their children, quality of life, and cost of living. And so we tried to front run that and take advantage of that demographic shift.
Well, plus you're taking all of us people from California, I mean, that's first in history we lost a Senate seat, and there's a reason for that. I mean, our taxes are too high, regulation, crime, all that. I mean, we do have, generally speaking, good weather, but it was kind of crazy a couple of weeks ago how Newsom had said, by 2035 we want all cars to be, I think it was all cars. I don't know if he said 50% or all cars to be electric. And in the same day with the heat wave, it was, but don't plug in your car because we don't want to overdo the grid. So it's like their policies are so backward. And you and I were mentioning, I mean, I've been in Tennessee and it's a beautiful place. Everything seems new. I mean, every place got its crime and everything, but Tennessee's beautiful. My son works for a large company where he's living outside of California, but it's California based. And I think he only has to visit here maybe once a quarter. Obviously as his dad, I want him to visit more, but nowadays there's a lot of work that you can do remote, except for digging ditches, manual labor type of stuff, but a lot of the stuff with the computers, you can just get done. Okay, so let's talk a little bit about the syndication platforms, because it says here it's focused on taxable high net worth investors and family offices. So first of all, like where are, we've pitched to family offices before. The hardest part we had, and I say we, I mean Pacific Private Money, is that we were too conservative with our mortgage pool fund. We weren't paying a high enough interest rate. That's changed a little bit because we're paying either 7, 8, or 9%, but still, a lot of these guys don't get out of bed unless they're going to make 12 or 15%. So generally speaking, you're putting these office, are they primarily office buildings?
Typically light industrial flex properties.
Light industrial flex. Okay, that's good. I mean, to me, I think that's a good place to be. You got, even the warehouses like, Amazon and all that. There seems to be a big need for that. And so are you doing longer term leases or shorter ones?
So our weighted average lease term is typically somewhere between 3 to 5 years, depending on the opportunity. And there's pros and cons, right? Having that stability and that cash flow is terrific, but in an environment like we're in today, that's hyperinflationary, you actually can push rents in a lot of these markets. So shorter term can sometimes mean that you can create value sooner rather than later.
Yeah, it's challenging. I kind of have some experience in that because I own some property, and the problem with the short-term ones, especially if you're in a market where there's a lot of changes going on, when these tenants move out, you've got potentially downtime, more commissions to pay, and tenant improvements. And so it's almost better to just let them stay there a little bit long. And here's the thing is that and this is way before, this is back in the late 90s, early 2000s with the dot bomb, was rents dropped so low, you couldn't even give an offer to a company to say, look, I'm going to drop the rent 75%, just stay in the building. And they say, sorry, it's not worth it for us. So it definitely has its challenge. Generally speaking, what kind of loans do you like to get for your buildings? What loan to value and that sort of thing?
Yeah, we're typically 50 to 60% LTV. So, 60% debt, 40% equity. Everyone's common equity. So we don't have any preferred or mezzanine debt. It's a very simple capital structure. Yep. Historically, we've worked with CMBS and life companies. Okay. Obviously, in today's environment, they're not in the market. And so we pivoted towards more typical bank debt. But we have flexibility. And again, the debt piece has been the most challenging the last 6 to 12 months.
Yeah, what kind of rates are the banks quoting right now for what you're looking at?
All in, you're probably looking at something with a 5 in front of it. So 5.5, mid 5s. They pretty much all baked in, another 100 basis points from the Fed. That might be too conservative, frankly, after what happened yesterday in the announcement. But yeah, our lending costs are typically in that 5% these days.
And is that going to be fixed for 7 years or 10 years and then float thereafter?
We've been doing more short-term debt because we don't believe this will be persistent over the next 5 to 10 years. So these are typically 1, 2, or 3 year type bridge loans with optionality to extend 1 or 2 more years, but more near-term expiration.
You'll probably get a better rate too, then I would think.
Correct. Yeah, that's right. And we get a better rate, and also we've been doing lower LTV in order to also produce better rates and better interest-only options. So we've been going from typically a 60% LTV to today we're more like a 50, 55% LTV.
And that should just help you get a better rate. Of course, you have to raise a little bit more money, but if you have a good reputation, and we'll talk about that in just a minute. We're going to cut to our second commercial break here. What event led to the creation of the super fund? And I'll even give a hint, what catastrophic event led to the creation of the super fund? All right, with a capital S. All right, stay with us. First of all, call 888-912-1190. First caller with the correct answer wins the tanning certificate. Stay with us. Best of Investing. We'll be right back. Welcome back to the Best of Investing. Edward Brown here along with Brian C. Adams. Do you actually use the middle initial? It was in the resume that you sent me. So I've been using the full Brian C. Adams.
I do. For people of a certain generation, Brian Adams can be,
Yeah.
a confusing name for some folks. So I use it as just a stopgap
Sure.
yeah.
Well, there was a famous rock star. I guess he was kind of a rock star, Brian Adams. All right. Second trivia question: what event led to the creation of the Super Fund?
Exxon.
No, it's before that. 1979, the 3 Mile Island incident in Pennsylvania. All right. Well, so far you're batting 500. That's still pretty good. That'll get you in the Hall of Fame, right?
Yeah, I knew it was something around the lines. Yeah.
All right. Okay, so Brian, your specific funds, you're raising money from individuals, pension funds, RIAs, family offices, right?
Yeah, we're very tight on our clients that we serve. So we only work with taxable investors. So for us, that's accredited non-institutional investors. So high net worth individuals, family offices, or RIAs or boutique wealth management firms that serve those folks. We don't work with institutional capital or private equity.
How long have you guys been around?
11 years.
11 years. Okay. All right. Let's see. That would put you down 2011, roughly. Okay. So we were still kind of in a recession, coming out of it. I presume you guys probably have a pretty good track record then.
We do. It's not bad. I think we had timing on our side initially. We haven't been through a full cycle, so I think we're about to.
Okay.
So
Fair
we'll see how we
enough. I appreciate the honesty. How much assets under management do you have?
650 million.
Really? In 11 years? That's pretty good. Wow.
Really, I've learned in real estate that it's all very relative. We have the saying YPO that somebody always has a bigger plane. So I don't put a lot of credence in AUM or square footage. I used to when I was younger, and I found those moments where you hit your milestones associated with those metrics to be very depressing. So I enjoy what I do. I like the people I work with. I love transacting, but I don't put a lot of stock into the ego metrics, frankly.
Yeah, but here's the thing though: is if you do a lousy job, you're not going to have the asset, right?
That's right. So I've certainly made a lot of mistakes, but yeah, it's been fun the last couple of years.
Okay, fair enough. Let's see. So you have here direct co-investment structure or RIAs, boutique wealth management, family offices. Okay, so that's how you're kind of doing it. And do you guys put your own money in the deals too?
Of course. Yeah, we act as the GP sponsor, so we're an LP, and we take on the personal guarantee risk ourselves as well.
Well, very good. And I'm trying to think of, okay, obviously tax advantages of direct real estate ownership, you get depreciation, that sort of thing. I would think that are you guys formula, is it LLCs that you do?
They're SPV LLCs, yeah, so they're all standalone investments, no cross-collateralization on debt or equity with other deals. That's right.
Okay. So then your funds actually qualify for QBID too, then, don't they? This income deduction, because they're pass-through entities, right?
Correct. So it's return of capital until 100% of your money is back. So it's a non-taxable event.
Yeah.
And thereafter it's ordinary income.
Yeah. But I mean, the QBID, like all of Pacific Private Money Funds qualify for QBID. So the 20% of the income that gets paid out, if the individual investor qualifies, and it's like if they have an income under a certain amount, 20% of it's tax-free. So I would think that you guys, if you're a pass-through entity, which you are, and they're passive investors, that I would think that they would qualify. Of course, the CPAs would know that. On you sent out K1s, right?
Correct. Yeah,
okay,
we have two tax professionals internally. So I don't know. I assume we do. I don't know.
Yeah, you just look at on the K1, it'll say something about Section 199.
Okay.
That'll be on there. It just adds an extra benefit for. Now, some people it won't matter because their income's too high, so they won't qualify for it. But for a lot of people, they will, even though they're accredited investors. A lot of times, accredited investors don't have a high enough income, but they have a huge net worth.
Right. Yeah.
Okay. Hey, I want to go back to your law school thing. So, yeah, I assume that, you learned a lot. I mean, and you passed the bar and everything?
First time, so they
Right?
tell me.
Hey, not bad, not bad. It's better than me. I mean, at 6 years of high school, I finally made it through. But so, I mean, you got to learn all about contracts and negotiation, and you probably, you passed the bar. But it sounds like, here, let's put it this way: I'm sure you hire really good attorneys, but because you have the knowledge, you at least know what you're talking about, and can speak intelligently with them. You know what I mean?
Yeah, I think we can gain the opportunity and the skill set to take large amounts of information, synthesize them into cogent, words and written form. And certainly you can see the fact patterns and the flags, but the actual legal work, I'm happy that I no longer do that type of product, and I've retired my license. So.
Yeah. Hey, let me go back to the fact that you're mostly, in the light industrial area. With interest rates going up, cap rates, I'm sure they have to follow, which is theoretically going to depress the prices. So are you finding some bargains out there?
I have never seen a rising cap rate environment in my investing career, and I've yet to see it happen today. It might be coming. That being said, I think that the challenge that we see that a lot of people don't talk about domestically is there are challenges in the U.S. for certain. I do believe we will go into a recession. I think it's going to be very volatile. And if you take a look at the rest of the world, the other options are very unappealing. And so when we talk to international family offices about deploying capital, it's pretty much us and Australia are the places that they're looking at.
Wow.
And so when you have that type of inbound capital flow, it just compresses cap rates and keeps them in check. So they may rise. I think, especially if you're in an emerging market,
because we're still the safe haven, and that's why the euro has dropped. Hey, tell you what, we have to cut to our third commercial trivia question here. What is the name of the rabbit in the movie Bambi? If you have kids, you should know this. All right, stay with us. The Best of Investing will be right back. Welcome back to The Best of Investing. One more time, I'm Edward Brown, your host, along with my special guest, Brian C. Adams of Excelsior Capital. Third trivia question: what is the name of the rabbit in the movie Bambi?
I got nothing.
Yeah, nothing. Thumper.
That's right, Thumper.
That's Thumper, but that's okay. You were still 1 for 3. That gives you a batting average of 333, which will ordinarily
in the Hall of Fame.
Yeah, it still gets you in the Hall of Fame. Exactly. All right. So, Brian, if people are interested in what Excelsior Capital has to offer, how do they get a hold of you?
Yeah, I appreciate that. I'm very active on LinkedIn. So if you look up Brian Adams, Excelsior Capital, shoot me a note, connection request. I'm happy to do so there. And then ExcelsiorGP.com is our website, which we have a lot of resources, and you can check out the portfolio and learn more about some of the blogs, white papers, my own podcast. There's a lot on there for you to check out.
Okay. And as investors, I know they have to be accredited investors. Generally speaking, what kind of distribution rate are they looking at?
In today's environment, it's less than it was a year ago. But we're trying to hit a 10% cash-on-cash yield annualized over a 10-year hold period.
Okay.
With some type of mid-teens IRR and a 2x multiple.
Oh, that's very respectable. Yeah, that's good, especially with those kinds of leverage. That kind of leverage, it all depends on the interest rate you're going to get versus the cap rate you're buying and expenses and all that kind of fun stuff. Yeah. So moving on here, so Pacific Private Money, I do a lot of work with them, investor relations, and interestingly enough, we've been pushing a lot for our Pacific Freedom Fund because we're paying out 7% for 250,000. 8% at 500,000, and at $1 million or more, 9%. The best part of it is it's liquid. So all you have to do is give us 30 days notice when you want your money back. And the reason we can provide that liquidity is because every roughly 2 to 3 weeks, we're packaging up millions of dollars worth of loans, selling them to the big boys, the institutions, get the money back, put it on the conveyor belt, and keep just doing it again. So a lot of times there are advisors and other investors who are waiting for their next investment, and rather than park their money in a 0.2% bank account, they figure, well, why not park it at 7 or 8 or 9%, very conservatively, and they get their money back in just 30 days notice. And interestingly enough, depending upon the timing, I've seen a redemption request fulfilled in 4 days, because at the time when the money was being turned over. So, I personally, I've been in this business a very, very long time, and I don't know of too many investments where you can have liquidity, very conservative, and a high rate of return, a relatively high rate of return. I mean, we're not hitting your 10% rates, because especially in California where we're making loans, the interest rates we're charging borrowers are getting kind of close to 10%. So obviously we got to, make money as a company, so we can't pay out the full amount, right? And charge some points, keep the lights on in the building. And for more information on that, it's pacificprivatemoney.com. Their phone number is 415-883-2150. They do have another fund that's a construction loan fund. And that one, they are actually hitting their 10% mark on that. It's an unleveraged fund, but they're doing, construction loans. In our Southwest fund, we're just paying a flat 7.5%, buying discounted notes. And then we have another fund that we're just, paying between 6 to 7% on. So again, for more information, go to pacificprivatemoney.com. So Brian, what else do you want to cover here? It looks like, again, heading into this recession, I mean, you got to be kind of picky as to the kind of assets that you want to invest in.
Yeah, I think a big misconception in the real estate world, when people ask what the three most important words are in real estate, the right answer is basis, basis, and basis. So in this environment, you're married to your basis for the entirety of your hold period. And I think we're going to see a lot of sponsors who were over-levered, that paid up way too much on these assets, get washed out when they can't refinance into a lower interest rate environment, but they can't operate correctly in this environment. So I'm very cautious.
Well, it's been said that you make money when you buy the asset, and I guess that's kind of what you're getting at, is if your basis is low enough. Yeah, interestingly enough, when we're buying, discounted loans, it's kind of the same way. Where if a house is worth 100,000 and the loan is 60,000, and we're buying it for $44,000, our loan to value in that case is only 44%, which is actually that's high compared to what we usually are. Our numbers are really closer to, the loan is 44,000 and we're buying it for 29,000. So we're actually right around 29% investment to value, as I say, on the discounted loan. So,
makes sense.
And on something like that, you can see a 25% drop in real estate, and you're really not affected that much. Because even if the borrower defaults and you have to foreclose, if you're selling the house instead of 100,000 at 75,000, you're still making money.
You're still good money. Yeah, makes sense.
So what kind? We have just a couple of quick minutes before our last commercial break. What kind of tenants generally? Because you said light industrial. What any kind of known tenants that obviously don't have any personal information, but
sure. Yeah, so in these flex buildings, we like to call them the mullet of commercial real estate, where it's business in the front and party in the back. So we typically have, like HVAC servicing company is a good example. They have actual administrative staff, executive staff. They need some type of office. They might have some customer fronting functionality. That's typically 25% of the space. And then 75% of the space will be distribution, storage, warehouse, maybe even full dock door access. And so those are the typical users, and it's a spectrum between local, regional, and institutional credit. We don't get a lot of institutional credit, but every once in a while we do.
Interesting. Yeah, my actually, interestingly enough, the building that I owned is right, just exactly what you just explained. And I've owned it since 1994, but it definitely, interestingly enough, going through two major bad situations, probably, the year 2001 and then, 2011, 10 and 11 was really pretty challenging. And coming up now is going to be probably another challenge, Yeah, my loan, I think I'm at 3 point something percent. and I did that 2 years ago, and I got a 10-year fix. So hopefully by the time it comes due, it'll be back to a normal rate.
I think you'll be okay. That's a good deal.
Okay. Yeah, you know what's funny though is that before, when I first took over the building, that was before the internet for the most part, and so I had low rates, and then I locked the next tenant into low rates, and this thing skyrocketed during the .com, and then by the time these leases came due, it was .bomb, and so I never got to enjoy the upside of it. Yeah, it's just the timing of it.
You need to lose the deal. That's the important thing. You got to stay in the game.
Yeah, and then that's the thing is if you can weather the storm, then you should be okay. Again, Brian, before we cut to our break, go ahead and give out your information if you would.
Yeah, I appreciate that. So Brian Adams, Excelsior Capital. You can look me up on LinkedIn. I'm very active on that platform. And then ExcelsiorGP.com is the website. That's where you can find the most information about the work we do and the portfolio, as well as access to resources that we put together for our investor community.
Very good. All right, stay with us. The Best of Investing will be right back with some closing comments. Don't touch that dial. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with my special guest, Brian C. Adams. We didn't have a trivia question, but Brian, you wanted to bring up another topic.
Yeah, it's interesting. I think investors don't ask the right questions when they're talking to sponsors and GPs. They can review the deal, they can diligence the hell out of any particular investment, but the real questions they need to be asking are, what does the investor experience, the investor journey look like? In other words, once you enter into my world and you were to invest into one of our properties, what does that look like daily, weekly, monthly, quarterly, annually? What are those expectations? What does my tech stack look like in terms of customer relations, social media, access to different kind of value add beyond just the investment itself? I think it's time for investors to be more aggressive and expect more from sponsors and GPs beyond just showing them deals.
Yeah, back in the 80s when limited partnerships, specifically real estate partnerships, were sold, the leverage was 60, 70%, but the sponsor was taking like 20% up front for their various fees and stuff. And thank goodness that got chopped down quite a bit because, you take 20% out of the deal, you now make 25% of your money just to break even. So you keep your expenses down quite a bit. And when do you guys send out your K1s?
So we were militant about sending that early, so typically mid to late February.
That's awesome. I mean, it's very rare to find an operator who can send them out that, especially when you own real estate because of all the various expenses that go in.
Yeah, it's one of the mistake I made in my career was being late on those, and I refuse to do it anymore. I'm not the sticky wheel, and it's been huge for the LPs and also managing that period of time. Yeah.
And do you guys get into cost segregation type stuff, or?
Oh yeah, we run cost seg analysis every deal and push through as much bonus appreciation as we can. Obviously, different assets have different percentages, but it's a big part of what we do. If you can show a 10% yield and show the loss in your K1, super powerful investment for a taxable investor.
Last question: How long do your investments generally last? Like, as a client, when do they expect to eventually wind it down?
Sure, we underwrite to a 10-year hold, but I'd say on average it's a 6 to 7 year type of hold period.
So generally the commitment, someone who invests can generally expect a 7-year hold on that. Okay, very good. Okay, we're going to thank you very much, Brian. We're going to cut out. Here's our thoughts for the day. We always have like sort of funny thoughts and that sort of thing. Okay. So you want to hear a word I made up? Plagiarism. Okay. And a police officer radios into the station. Sarge, we have a situation here. Yes, go ahead, comes back the answer. A woman just shot her husband for stepping on the floor she had just mopped clean. Have you arrested the woman? No, sir, the floor is still wet. I thought that was pretty good. I like that one. So I didn't hear a laugh out of the plagiarism one. You didn't like the fact that I made up the word plagiarism? Okay.
I'm still digesting that one.
Yeah. Our regulars on the show, they kind of know what to expect. So it's a little bit challenging on that. Again, Brian C. Adams, thank you very much. Excelsior Capital, check them out if you're interested in investing in light industrial type in Florida, Tennessee. Expect a 6 to 10 year hold. Distributions hopefully hitting around the 10%. Mostly, if not totally sheltered, at least in the beginning by depreciation and all that. Check them out. All right. And also check out pacificprivatemoney.com, where you can get a nice high yield at a conservative rate, conservative assessment for risk and liquidity, which is the best part, at pacificprivatemoney.com. Tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.